So, once again, everyone, good evening and thank you so much for your patience. I see a lot of people have already joined, so we'll start the session now. Let's check in commodities, for example. Let's check for gold. Gold, anyways, it has moved up so much. And again, a daily chart. Let's say technical, same way, RSI. Again, let's make it 70 and 30 so we can see some areas. Right. If I zoom out a little bit, look at these major peaks and look at these bottoms right here. Look at these overpriced territories. I'm just zooming out because it's a daily chart. So if you see, look at these peaks. Some of them are really big, and gold being on the higher side. But if you see the buying levels, look here. Look at this. Right. So 30 is the oversold category. This is where you need to be buying, and then this is where you need to be selling. But if you see here, even in RSI, need to have the resistance. Now, in this case, because gold has been on a bullish trend for so long, I can actually edit my RSI instead of 70/30, can make it 80/20 and save this. So you will see that this is where how closely you can make your RSI work. Because look at this peaks right here, right? Just because I made 80/20 gives you more bandwidth to take a much safer trade at this time. And again, the supports can be booked around, the profits can be booked around when you short sell here. The prices can be, or the profits can be closed around when an RSI reaches to 60 because it's an upward trending market, right, for gold. Plus, buying levels could be around 20, right? This is where could be a good buying. So you're looking at a daily chart right now, guys. Again, it could be a very helpful study. If you have any questions, please feel free to ask. But a lot of traders would look at RSI. Now, this is for a daily chart you're looking at. There are different time frames which you can look at RSI, and it depends which is the best time frame. I mean, RSI indicator, if you look at the best setting, short-term intraday traders which are doing day trading, they are mostly looking at different settings. Like longer term position traders, they offer a period of 20 to 30 time frames. But again, the idea is that this can be applied as a strategy, and this can be done on a shorter term chart, can be done on a longer term chart. If you are looking at for a day trader perspective, like a lot of traders, they're actually using RSI in a day trading strategy, and it becomes really beneficial for them. And the default setting which we used, 14 periods, which is suitable for most traders. And again, it could be a 70/30 or a 80/20 sort of a period, and you can look for different time frames. Now you're looking at a daily chart. You can look at a 4 hours chart also if you are going a little short term. So for example, right now this is day. Let me clear this out, and I'm going to make a 4 hours chart. Right now in 4 hours, when I go with my technical, I click on RSI. Again, let's say 80/20 here. Look at this. This is a 4 hours chart. Again, very clear. The peaks here are 80. So this is the oversold category, and you see that every time, sorry, overbought category, the above one, and how you see that it reaches to the peak and comes down. Similarly, buying, if you see, look at these troughs, look at these bottoms right here. This comes into the oversold category. So this is where you buy, and the above peak is the overbought category. Right now, again, as you see, gold again lands here to 68, which is again right now, I would rather wait because it's a 4 hours chart. But still wait until I see a overbought category or a oversold category. But if I reduce the duration to 30 minutes, for example, again, if you see RSI confirms 34 hours one day, everything is 60, 62. Means you must wait till it reaches to either 80 or reaches to 20. This is where the overbought or oversold categories might be. So that's RSI for you. You can always try to put this into different stocks, different instruments. Even sometimes when you are looking at stocks, let's say, um, I don't know, maybe Nvidia. Open a chart. This is a daily chart. So maybe if I select RSI, same indicator, increase a bit. Again, right now, if you see, Nvidia has been on a bearish category actually, and it's around 50, which is as a resistance right now. But this is 80-20. I would suggest that if I were to do a setting, maybe a 70-30 would be an ideal setting for this. It's not in a very upside moment. So now, if you see, it becomes more clearer. So right now, 49, it's at a resistance. So I feel that as per the RSI, the stock should come down a bit. And once it comes into the oversold category, which is here, right? Let me draw it out for you. Somewhere around here, this is where the buy should be, while the oversold, or so the overbought category, which is here, look at this. This should be the category where you should sell. So somewhere around 83. So I feel that if, as per the RSI, Nvidia prices reach around 82 or 83, should be a good sell or a good buy around if it reaches 30 or 31. Right now, it feels like it's around 50. So in a bearish market, if it is around 50, it acts more like a resistance. So it should come down a bit from what we are looking at. Right. And see, there are a lot of ideas. Which is the best product to be suited to RSI? That is something which we need to understand. There are a lot of complementary indicators, like, for example, Bollinger Bands, which you are going to use, also learn. It could be a good addition to RSI. I mean, obviously, I also don't want to mix two indicators, but sometimes it happens. Maybe, two indicators, they indicate in the similar way, and there are buying and selling signals which are indicated. But then when we are using RSIs, we need to understand that there are a lot of products which you can trade with RSI. It could be gold, could be index. Sometimes it can give you an idea of where the sell signals are, where the buy signals are. And a very related strategy next to RSI, or a very related study to RSI, is the stochastics, because both RSI and stochastics are oscillators in technical analysis. Nature is very similar. The mathematical formula to create both indicators is slightly different, because RSI is calculating the average gain versus average loss. Stochastic is basically calculating the closing price to the highest low and the highest high. So when we see an overbought or oversold reading at 70-30 for RSI, for stochastics is 80-20. But both the indicators who are producing these signals, they're not although exactly the same. Some of them like to add indicators both ways. Like they would like to see RSI and stochastics together, just to give you an idea how RSI and stochastics can be used. This is technical. While I have used RSI already, I can use stochastics also. 80-20 again. You click on save. Now, if you see, even the stochastics, RSI, both are along the same period. So again, as I said, that sometimes scope. I mean, when we look at um, the RSI, we also look at, sometimes we look at stochastics also. Stochastics is also one indicator. I've not mentioned stochastics in this particular presentation, but since we are talking about it, and I've put it into this just to give you an idea. So stochastics basically compares the closing price of a stock to the how high or low it has gone to. What is the sensitivity? So if the stock moves in a market movement, So how sensitive it is. So it's a very popular technical indicator also. Again, it also tells you overbought and oversold. And again, the concept is very simple. Recent price scale is 0 to 100. If it is above 80, it shows asset is overbought. If it is around 20 or below that, it shows again the oversold category, and you can buy at that particular time. It's a momentum indicator. It tells you like comparing a particular closing price of a stock to a range of its prices over a certain period of time, like how it has the current closing price which you see as compared to the highest high, lowest low, how it is compared to the range to which the stock price has moved. So there are many such technical indicators. I showed you stochastics, RSI. Next one to discuss is right here, which is MACD, moving average convergence divergence. MACD is again a very popular indicator, and it's again there are different implications of MACD. It is not something which is very difficult to understand. Also, it is also a momentum indicator. Right now, what I'm showing it to you, it's a very much momentum indicator. It shows a relationship between two moving averages. First, we need to understand what a moving average is. Right? If I tell you what moving averages are, you will understand how a moving average works, and then what is the concept of the MACD also. Right? So currently, let's say I'm looking at. Uh, let me. Okay, you can see the screen. Let me show you the moving average part. So let's take example of Nvidia actually. So what a moving average indicator looks like. Moving average are two kinds. One is a simple moving average. Another is an exponential moving average. But for you to understand what a moving average is the average closing price of a stock or a commodity or an index, whichever chart you're looking at. It is a average closing price, which means if I'm looking at a 50 days moving average, I would be looking at an average closing price of this particular stock like Nvidia for over a period of 50 days. So in last 50 days, average closing price of Nvidia has been what? That's the idea. So how do I make it? I go to the technicals, I click on moving average, period 50, type simple moving average, and 50 period. And let me make this line more visible and yellow. So if you see this is the moving average line for Nvidia, right? So right now you're looking at a 50-day moving average line. Concept is very simple. If it breaks below the 50-day moving average, which means a bearish trend could start because it has broken the average closing price of 50 days. It is going down below that. Any average which is broken above or lower, it starts a trend. So today, if right now Nvidia is very close to break the 50-day moving average. Now this duration can increase, right? Right now you're looking at a 50-day moving average, which is some sort of short term. If I were to edit this and make it a 200-day moving average, because I'm looking at a daily chart and it's a long-term chart. Look at the 200-day moving average line. This 92.7, this is the average closing price of Nvidia last 200 days. So this is the average which is calculated. If we were to calculate the 200-day average closing price of Nvidia, it comes to 92. Right now it is still 115. This will lay a very significant impact in case if the stock price of Nvidia was to drop and reach around 100 or 92, which will be very close to its 200-day. So that indicates a good buy signal. But if it breaks this 200-day moving average and falls below 92 and goes to 89 or 88, that could spark a bearish trend in Nvidia, right? So moving averages are very important because it indicates the average closing price. And the longer duration, the shorter duration, it impacts really much. Now, that being said, how do I understand the moving average convergence divergence, MACD, which is an indicator, right? It's again, as I said, MACD is a very important indicator. Um, it's a momentum oscillator or indicator. But primarily, why people use MACD? To trade trends. It is an oscillator, without any doubt, but it is not like how RSI identifies overbought or oversold categories. MACD is not supposed to identify overbought or oversold conditions. It appears on the chart. There are two lines, right? They oscillate with boundaries. Uh, there is a crossover of the two lines, and that crossover gives trading signals which are very similar to a moving average system. And I'll show you the live chart, and I'll tell you how this would work also. Because MACD, say for example, there are two lines which are very important, which we must see. There is a signal line, right? Then there is a MACD line. Okay. So we'll show you how the divergence works, and we'll exactly show you how the indicator would also work. Let's say, since you're taking the example of this stock, click on technical, click on MACD right here. If you see 1226 right here, click on save, and let's understand here. Right, just look at this signal, what I'm going to tell you right now. Okay, now first of all, see this vertical line right now. It says minus 0.72, right? So right now MACD is around here, right? It's below zero. It's around minus 0.72. So remember this, whenever there is a MACD crossing above zero, it is considered bullish. Okay. But when it is below zero, it is bearish, right? If below zero, it is start moving higher, it is again bullish. But from higher, it starts coming towards zero, it is again bearish. So when you see MACD, there is a signal line, and then there is a MACD line, right? You're looking at two lines right now. When the MACD line crosses from below to above the signal line, that indicator is considered to be bullish. Okay. But if the MACD line crosses from the above to below the signal line, indicator is considered bearish. When we are looking at MACD strategies, we can also form trend lines when we are doing that. And obviously, I mean, the concept of MACD is very simple. You are calculating the MACD by looking at a 26-day moving average, then you are looking at a 12-day moving average, right? And then you see a signal line is created with that. Let me show you how it is mostly used. So look at this. Look at the crossover over here, right? One second, let me edit this. Okay. Now the white line which you see, sorry, 1 second. Yeah. Now the white line which you see, this is the MACD line. This is the white line. The red line which you see, this is the MACD line, right? Now, always remember this. As I said, MACD line, when it crosses from below to above the signal line, then the indicator is bullish, right? Look at this right here. And again, I'm going to show you the white line is the MACD line and the signal is the red line. So if you see this red line, this is the MACD line. So whenever you see, as I said, whenever you see the MACD line crossing from below to above the signal line, the indicator is considered bullish. So here, if you see, the signal line is the red, MACD line is white. Because this red line, which is a signal line, is crossing over to the downside, see a downward trend has begun. Even now also, if I zoom in, there is no crossover happening, right? Look at this crossover right now. If you see here further, let me bring this to you. See, look at this crossover. Look at the signal line, how it crosses the MACD line on the downside, right? So this is really important to identify the trend. When MACD line crosses from above to below the signal line, that indicator is bearish, right? When the MACD line crosses above or from below to above the signal line, then it considers to be bearish. So a lot of times it happens. If you see the bearish indicator over here, clearly right here, right? Look at this crossover on the downside. Major crossovers, look at this crossover on the downside. Again, the crossover on the opposite side, on the higher side, right? Look at these, or this is moving parallel. Look at this. This is the crossover right here. Again on the downside. This crossover, look on the positive side, right? And if it's going above zero, then it's bullish. If it is going below zero, it's bearish. Look at this. This crossover on the positive side, right? So this is normally how MACD works. And currently we are looking at, again, the crossover is pretty much uh, parallel right now. At this point, it is still below zero. So it still looks bearish unless the crossover goes above zero right here, as you see here, still bearish, right? Unless it goes above, only then a bullish category could be formed. Right now, see, a crossover happened here and stock prices fell. Look at it once it happened here, and look at, just compare, see this, look at this movement right here. See, look at this movement right here, right? And then look at this movement right here, which happened at this crossover on the higher side. So you can always match, you can always see how this works. Again, guys, when I talk about MACD, a lot of these oscillators have been used. I'm giving an example here by showing it to you in NVIDIA. You can always try and see. The best part is when you're doing trades using these kind of technicals, the best to do is use a dummy account and then put these technicals to use and see what happens. So just to, I already showed you what MACD looks like, but then since we are talking about it, just to give you an idea, this is what MACD looks like. There is a signal line, there is a MACD line, and whenever there is a crossover um, towards the zero line, you see a bearish trend happening. Whenever there is a crossover above the baseline, which is the zero line as I call it, you see an uptrend happening. So there's a MACD line, there is a signal line, and that is how you identify the reversals in MACD oscillators. Right, guys, this is one. Moving on to the next indicator, which is Bollinger Bands. And then finally, we'll move to double moving average crossovers to understand that how the double moving average works. Double moving average, we take a 50-day moving average, 200-day moving average, and then try to understand that how these moving averages would work and how the moving average crossovers would work. Not very different from what we looked into MACD, but definitely we can try doing this in different instruments. Now, Bollinger Bands also is something which is very interesting. And you will find it very interesting once I show you how this works. And Bollinger Bands is slightly difficult, not difficult, but slightly different from RSIs and what we have heard. So Bollinger Bands was developed by John Bollinger, and back in the early 80s. And the most intriguing thing about Bollinger Bands is they use standard deviation and a moving average to help the traders so that they can determine the buy and sell events. And there are a lot of price charts that use Bollinger Bands. They display four lines, at least three lines. There's a upper band, there's a lower band, and then there's a moving average. Okay. Upper and lower bands, they appear two standard deviations above, below the 20-day moving average. Shorter term trends, some technical analysis prefers 1.5 standard deviation, 10-day moving average. Longer term trends, 2.5 standard deviation, 50-day moving average. But what is the purpose of Bollinger Bands? It basically provides you an indication of a higher and lower price range. Okay. If prices will be high at the upper band, it will be lower at the lower band. It would bounce between the upper and the lower bands. And again, uh, expansion or contraction of the bands also happens around the moving average, and again depends on the high or low volatility also. Let me show you exactly how this works, because with technicals, more I speak, more I describe, it's only going to bore you. So I'm going to show you exactly how Bollinger Bands in terms of technicals would appear. Let me just show it to you. Let's take example of uh, say gold, for example. Or let's, since we're talking about stocks, why not let's just take example of Nvidia, as we have taken many examples. Again, you're looking at a long term chart, right? So you're going yearly. Now to put Bollinger Bands to this use, I'm looking at from 2023 this chart, slightly longer term. Let me show you how Bollinger Bands is made. So you click on Bollinger Bands, shows period. Okay. Now period means the line which will be in the middle, which will be the moving average period. So how I explained it to you, the 50-day moving average, which shows the average closing price of 50 days. This is the average closing price of 20 days, right? But because I'm looking at a long-term chart, so I'm going to change it to 50 days. And similarly, I'm going to make standard deviation. So now there is a standard deviation line. There are standard deviation lines. So why I said there are four lines, there is one moving average line, which is 50 days. There's a standard deviation, which is, I'm going to make 2.5, which is 2.5. And we can make this moving average as, say, exponential, or we can just keep it simple. Then there are going to be Bollinger Bands at the top, at the bottom, and then again there's a median. The median is the standard deviation line. So the upper band shows maximum deviation from the average. Lower band shows the maximum deviation on the lowest side from the average. So it shows you the buying and the selling signals. When I click on save, look at this band which has formed. Look at the middle line and look at the top. Right now we are looking at the 50-day moving average, right? Uh, Look at the upper band right here, 136, lower band 95, mid band right now it's 116. This is where Nvidia is at the moment. It goes below this band, a good buying signal comes across at 95, but I have put 50-day moving average. See what happens when I change this from 50 to 20 days. And standard deviation simple. So standard deviation tells us that how much prices can deviate. So if I'm looking at the upper band, which is the first band, from the deviation, how high the prices can go maximum. Standard deviation of 2 means 96% of the chances that prices will be around uh, this first band. 2 standard deviation also means that 96% of the times there are chances that the price will revolve around the lower band. So the lower band which you see with a 2 standard deviation, it shows that it has come down already, and 96% of the time, if you were to stretch this band, the lower band would only stretch to this much, majority 96% of the time, which means if the prices are around this band, you should buy, because 96 to 97% downside which this price could see, it has already seen. Same goes from the upper side also. I'm looking at this. Look at this chart. Like, I've changed the duration now. I'm looking at a 20 days moving average. Again, it's here. A possible good buying around 101. This is where the lower band is, because as per the 20-day moving average and two standard deviation, 96 to 98% downside which this stock can see as compared to this 20-day moving average, this is where the buying comes, 101. And a potential high which you see right now is 129. From 129, it might come down. So you see the width of the band, somewhere it is narrower, somewhere it is wider. That is because of the volatility. When the volatility increases, we see the width of the band also increases. Similarly, let's say if I were to put a band in gold, this is gold versus US dollar. Look at this chart right now. Draw, and I'm doing right technical Bollinger Bands, and here it is. So if you see right now, it's very close to this, right? It's already gone up a lot right now. But if I were to zoom out a bit, look at this volatility which has been produced. Now, ideally on this band, it looks like a selling transaction when I'm looking at a long-term chart, right? And a possible buy around 2454. But I'm looking at a long-term chart. Because I'm looking at a long-term chart, I must edit this, make it to a 50-day moving average, and let's say 2.5 standard deviations. So I get more bandwidth. And look at this now. It's very close, right? A probable short selling over here, a buying at 2480, or below that, a buying at 2320. Now looking at a long term, so the lower bands and the upper bands, they widen up because of the volatility. If I would go very short term, say 30 minutes, and edit this to say a 10 days moving average, and say 2 standard deviation, save this. So if you see on a shorter duration, look where the Bollinger Bands are. Right now it's still moving up. 2636 should be a short sell, and buying should be at 2620. I'm looking at a 30 minute chart. So this could help you as a trader to short sell at 2636, buy it back at 2630, or buy back if it comes down to 2620. Look how from the lower band it has bounced back here, here, again here, right? So again, this is one of the things which you can do when you're working on advanced technicals, right? This is what a Bollinger Band, as I said, would look like. This is a lower band, this is upper band, and this is the mid one, which is the moving average line, which gives you an average closing price of the product. As I said, we can always conduct one-on-one sessions for you guys on technicals. And this is something, again, it's an informative session. It's not something which you must know. I mean, there are support and resistances which are easy enough and understanding enough. But because we are investment consultancy, we provide you consultants who are already looking at these technicals day in, day out. So a lot of calls which are issued are supposed to be helping you out on this, right? But as I said, that this is an informative session, and it's been a month of so much information and amazing stuff. So we are just bringing you these kind of technical studies so you can understand. Lastly, double moving average crossover. It's basically two moving averages put together. And let me quickly show you on the screen that how this would work. It's basically the short-term moving average versus the long-term moving average. And I'm looking at a daily chart. And I'm putting two moving averages here now. So there is one moving average which is 50 days, simple moving average, this is the red line, and then another moving average by clicking the same window, and this time I'll make 200. And this, I'll change the line to yellow. So if you see on a long-term chart, a 200-day moving average line versus a 50-day moving average line. Now, the real action starts during the crossover. If the long-term moving average crosses above short-term moving average, then the prices are mostly bearish. If the short-term moving average crosses above long-term moving average, the price trend is bullish. Look how it worked out here. If you see, the red line crossed the yellow line. Red line is the 50-day moving average, while yellow line is the long-term moving average. So when this crossover happens, it's called double price moving average crossover. When this crossover happens, we see that the trend turns bullish. And when the opposite happens, when the yellow line, which is the long-term moving average line, crosses over uh, the trend line, sorry, the short-term moving average line, the trend is mostly bearish. So if I see this, look at, I'm zooming out a lot, 2023 again, for example. So look at the crossover over here. See, the long-term moving average line crossed over the short-term. Look at the bearish trend right here, right? Again, if you see here, the short-term crossed over the long-term, and look at the bullish trend over here. Again, see the long-term crossed over bearish, the short-term trend. So this is also an effective way, guys, to look at a long-term perspective. Right now, if you see, there's no indication because both the moving average lines are very poles apart, but a crossover, if it happens, and if you see a long-term crossover might be bearish for gold, but if a short-term crosses over the long-term, as it has done over here, if you see this, the short-term moving average line has already crossed over. So here, if you see, the trend is mostly bullish and it continues to go higher. And that is the reason why we have seen this happening. So the price moving average crossover is also one of the effective ways you can look into these instruments and try to place the trades. Guys, technical analysis session, what I have conducted today, we can always sit one-on-one. There are so many technical studies, but this should not stop you from investing in financial markets. I have conducted this session to give you an idea about how technicals work. But a lot of, especially consultants, when they are looking at the trends and when they are explaining you about where the market opportunities are, they are basically putting fundamentals and technicals to use together. Sometimes it's possible, sometimes it's not. But we can have plenty of oscillators and studies to look into this. None of them always confirms whether it's the right trend or not, but then it gives you a general perception. You can get that perception from supports and resistances, and it's up to you what sort of technical studies you want to apply. But one very important thing, please remember this: it's not uh, the it's not like if you don't know how these studies work, you cannot be a good trader. That's actually a myth. What people feel, that if I don't know how RSI works, or especially a lot of these studies are not that difficult. RSI is like a no-brainer. You buy when it comes to 30, you sell when it comes to 70. So there are two or three important technical studies which can be very well understood. You don't have to know the math behind it, but you can understand the indication that whether it is shows a reversal or shows the overbought or the oversold category. Two or three technical studies followed by support and resistance is enough. You really don't have to go much deeper. There are some retracement studies like Fibonacci's and others, but again, that depends on your involvement. If you're a busy person, you don't have much time to give to this, you don't really have to give this much time. You don't really have to get into this. Um, as a swing trader, if you're waiting for the prices to fall, you can always speak with your consultants, and a lot of discussion can happen that what's the right entry and what's the right exit. And those right entry and exits can be based on very evident technicals, not something too complicated also. So that is where we end this session, guys. Thank you so much for your time. We discussed four technical oscillators today. And the reason for doing this only three or four is that's what it is important. there are 200 technical studies, and I'm sure not every study is going to be useful to you. That's why you pick the ones which are widely used, and at the same time, we can have one-on-one multiple sessions where you can understand, and we can understand these technicals more together. We can best is take a demo account and try to implement what I explained to you today. And for more understanding, reach me out. We can have a one-on-one session together and go much deeper into technical analysis if you want to. If you like the session, please go on Google reviews, Century Financial, and let us know how you like the session. It helps us, it keeps us motivated to do more and more sessions like this. And we're going to have more webinars coming in before this month ends. So just subscribe to our calendar. Look at our calendar and see which other webinars are happening. Today was on technical analysis, but tomorrow is going to be very interesting. And do attend the session tomorrow, because tomorrow is going to be uh, uh, finally the most impactful understanding on US elections, which are going to happen, the impact of US elections on your portfolio, and how it is going to impact your portfolio, what strategies you should use. And after that, day after tomorrow, we are going to talk about trading in essentials, trading in commodities. On Thursday, we are going to talk about the Chinese market outlook, whether you should invest in Chinese stock index or not, followed by some understanding of portfolio diversification, and then ending this month with understanding the earnings season, the corporate earnings, and how to trade during the earnings season, as October is going to be the month when most of the companies will disclose their financial results. That being said, once again, thank you so much for your time. My name is Yogesh. I'll see you tomorrow, same time, 7 to 8 p.m. And tomorrow we're going to discuss the impact of US elections on your portfolio. And it's going to be a very wonderful session. Definitely do attend this. We are going to discuss some portfolios and strategies, how they're going to impact, um, and what sort of stocks you could invest in. And we are also going to take a deeper dive on understanding how US elections actually work and what the US political system is like, and hope that that sort of information brings more awareness to you. So, once again, you have a great night. I'll see you tomorrow. Thank you so much for your time, and have a great night.